Assalamu alaikum friends. Welcome to today's topic. Today's topic is the continuation of IS 32, which is IFRS 9, one of the complex standard and the biggest standard. So before I start this video, let me tell you that this video will be divided into 11 videos. Yes, this is the only topic which is divided one chapter only, financial instruments, divided into 11 parts. So this there will be 11 parts to this video. 11 parts to IFRS 9. Okay, let me tell you the topics so that when you search my videos, you know that for each section I have different videos. The reason why I've taken it in different parts, not in one, because if I take it one, it might go up to 7 hours, 7, 8 hours. It's that long, right? So rather I have put it in separate videos. So if anyone, for example, wants to find information regarding any just one part, they can easily identify my video. Okay, so starting with it, this is the first part, and in this part I will be discussing only financial liabilities. Okay, how do you recognize financial liabilities? How do you initially measure? How do you subsequently measure financial liability? Okay, next part will be on compound instruments. Compound instruments means characteristics of both equity and debt. Then we have financial asset. Okay, that will be a small video because the recognition of financial asset is a very small part, but financial liabilities and the others are okay. So the financial asset is the only smallest video, the rest all will be the videos will be big enough. Okay, it might go more than 1 hour, 1 hour 30 minutes, like that. Equity instruments. Okay, the fourth part will be equity instruments. Fifth part will be debt instruments. Sixth part will be impairment of financial asset. Seventh part will be derecognition of financial instrument. Eighth part will be derivatives and embedded derivatives. Ninth will be hedge accounting. Okay. Tenth we have under hedge accounting, we have two types of hedge. One is fair value hedge, one is cash flow hedge. Okay, we'll be covering both there. 10th part and 11th part, that means the 10th part and 11th part of IFRS 9 will be test your understanding. Test your understanding 1 and 2. Why? Because there are so many test your understanding, around 21 test your understandings. So what I've done is I've divided this into two parts. Okay, so that means I will be doing all the questions there. All your test your understanding relating to chapter financial instruments will be done in the last two parts. Okay, that means when I'm explaining you the concept, I'm not going to do the test to understanding. Okay, I'm going to skip it because that will be done in the last part. Okay, so I hope you have understood the structure of the my videos, how it will be uploaded for the financial instruments. Okay, and it will not be done all in one day. So if you're finding out if you want to find out any of it, you will not get it, because every day I will upload only one part of it. So today I will be uploading financial liabilities. Tomorrow it will be compound instruments. Day after tomorrow it will be financial assets, like that. Each day I'll be uploading one. Okay. But that does not mean that I will be only with one topic. No, I will be simultaneously doing other standards also I'll be uploading, so that before the exam you get all the standards and you get time to prepare yourself. Okay. So on that note, let us start with financial instruments. Let us start with financial liabilities. Before starting financial liabilities, we went through this before also. Let me go through this again. First, when this chapter is introduced to you in your textbook, you will be given the introduction. Then we have the classification of financial instruments. That means financial assets, financial liabilities, and equity instruments, right? We have done this in IS 32, so I'm not going to do it here. Okay, we have dealt it IS 32. If you haven't checked my video on IS 32, do go check it out. Okay, definitely at the end of this video, you will get the link to both the status, IS 32 and IFRS 7, because you need it for IFRS 9. They are interlinked. Then we have the recognition and measurement of financial instruments. Here onwards, okay, from here onwards, we are going to focus. This is our focus point. I cannot highlight it because it's a whole picture, so you can understand recognition and measurement of financial instruments. Our starting point is from here. Okay, and under financial instruments, we have three: equity, financial liability, financial assets. So we need to know how to measure and recognize all these three. But this video is only for the financial liability, the first part of IFRS 9. Next, we have impairment of financial assets. We'll be covering in IFRS 9. Then we have derivative. Okay. Then we have hedge accounting. All this. So from recognition till hedge accounting will be covered under IFRS 9. Okay. Classification of financial instruments was covered in IS 32, and disclosure of financial instruments was covered in IFRS 7. So you can go check out my IFRS 7 video also. So now I'm going to skip through this because these were the definitions of the financial instruments which we have covered in IS 32. I'm not going to repeat it again. Okay. This also we have went through financial liabilities and equity, the classification. So we are starting from here. Recognition and measurement of financial liabilities. Okay. Now you have to know two things when you are measuring or recognition. Okay. Initially, your initial recognition and your subsequent measurement. Okay. Because initially what you recognize might not be the same as what you measure subsequently later on. It changes. That's why you need to know, remember two things. One is initial recognition, the other one is subsequent measurement. Okay, for both financial liabilities, and you need to memorize both. Okay, it's not one or the other. So how do you initially recognize financial liabilities? Initial recognition, they are measured at fair value. Okay, financial liabilities are measured at fair value. Remember, we have studied IFRS 13, fair value, right? Separate standard is there. That video is there on my channel, IFRS 13. So that also, so that you can use here, okay, for IFRS 9. This fair value will be interlinked with so many standards, okay? Don't worry about it. So initially you recognize that fair value, okay? That's one good thing, that most of the things are measured at fair value, so it's easy for you to remember. Whatever standards you go, you know that it is measured at fair value. That's one good thing about being fair value. Okay, next, what is it? If the financial liability, okay, two things you have to remember. If it is held at fair value, if it is not held at fair value. Okay, so the first statement is, if the financial liability will be held at fair value through profit and loss, transaction cost should be expensed to the statement of profit and loss. Okay, you have to remember, if held at fair value, okay, then transaction costs are expensed to the statement of profit or loss. If the financial liability will not be held at fair value, if it is not held at fair value, through profit and loss, transaction cost should be deducted from its carrying amount. What carrying amount? Financial liabilities carrying amount. Okay, you deduct the transaction cost there, then it's not expensed. You need to remember this. From here onwards, all the videos, whatever I explain, if there are any rules, for example, initially you recognize that this, subsequently you have to memorize it as it is. Okay, next. So I hope that this is enough for you. Initial recognition, fair value, and if it is at fair value, how do you account for the transaction cost? If it is not at fair value, how do you account for transaction cost? These two things. Now let us go to the subsequent measurement of financial liabilities. Okay, here it's not fair value. Here you have an option. Okay, either at amortized cost, either at fair value through profit and loss. Remember, fair value through profit and loss, because sometimes some has fair value through OCI, other comprehensive income. Okay, so you have to remember whether it's through profit and loss or through other comprehensive income. Okay, so amortized cost and fair value through profit or loss. Okay, let me tell you one thing, one hint for you. If you want to understand financial instruments very well, understand financial liabilities very well. That's why that is the first, it's given first, not financial assets or equity. Understand financial liabilities, initial recognition and subsequent measurement so well, because it will help you later on to understand financial assets and equity also. If you study one thing, you can apply it on the other places also. Okay, so this makes studying your IFRS 9 easier. So amortized cost and fair value through profit or loss, subsequent measurement, highlighted. Okay, Write these points, okay? If you're taking notes while seeing my video, I recommend you to take these notes, okay? Not even picture, because picture there may be so many images in your mobile, in your phone, that you might get confused at later on when you have to refer. So better write it, take a note, write IFRS 9, then make these notes, okay? If you have the textbook, there itself you can highlight. But if you are a person who have the habit of making notes, then better you write this note somewhere, the ones which I'm highlighting. Trust me, this will help you in the long term, okay? Then now they are breaking down the thing, okay? Amortized cost and fair value through profit and loss, okay? That is the next subheading, is amortized cost. And if you see the next one will be fair value through profit and loss account, okay? So from there, these two subheadings are derived. One is amortized cost, one is fair value through profit and loss account. That's it for financial liability. That is only broken down into detail. So now we are going to go through amortized cost, how to measure at amortized cost. So isn't it simple, guys? Right? Do let me know in the comments below, how did you find my explanation of financial instruments? It's very important for me to know this, because what happened when I was explaining AFM, I think last year I was doing videos on AFM. When I was doing risk management, okay, one girl messaged me. I will not disclose the name. She's a student, okay. She is an overseas. She stays in Malaysia. Okay, she's from Malaysia. She messaged me that she didn't understand my explanation of risk management, right? The reason why I'm saying this is so that other future students become aware, that let me know beforehand when I'm in that lecture, or because later it becomes very hard for me to again go through the same thing, right? Because already I'm now conducting SBR classes. It will be very difficult for me to go back in the AFM and also conduct individual classes for her, right? Because I was not aware whether it was understood, how it is received by you or not, whether you have understood or not. It's important for me there and that day itself that you let me know. Okay, I don't mind. You can give me negative comments. You can tell me if I'm not understood. Let me be very clear. Okay, be honest with me. Okay, I never mind anything. I appreciate the positive feedback as well as negative feedback, because it helps me grow. Okay, because from my side, honestly, let me tell you, I think that whatever I'm explaining, you are understanding it. I'm doing my best, but I actually need to know the reality from your side, whether is it so. Okay, so now what happened is, she didn't understand all the lectures I have done. I don't know, I think 52 videos. I don't know how many videos I've uploaded on risk management. Now she's telling me that she didn't understand any of the videos. Like, she didn't understand my explanation of risk management. She's finding hard to do questions on risk management. So I think that now I have to make a video again, videos for risk management in a more simplified version. From the basic level, I have to start again, right? Because there's no other way, because she's struggling a lot in that area. So I don't want that to be repeated later on again for any of my videos, or any subject, any area, any topic. Okay, that's why I always tell you to comment me. You can comment me below. You can even comment me on Instagram, on LinkedIn. I'm there on LinkedIn, on Facebook, on my WhatsApp, or you can email me saying that you have this issue, you want me to change this, or you want me, the way I deliver my lecture, you want me to change it. Please let me know. Okay, feel free, don't hesitate. Okay, we all are human beings. Okay, the way you have to improve, I also have to improve on my skills. I'm also daily learning, okay, things. Just because I teach you does not mean I know everything. I'm some big thing or something. No, I'm also a human being. No one is perfect. I'm not perfect either, so I make mistakes. So let me know those mistakes, okay? I don't want to know those mistakes in the last moment, because then I cannot come back and change it, or I won't have time that time, maybe. I might be busy with some other things. So please let me know in the comment below. Especially for this video, if not any other video, because this is a very complex. This is a topic where most of the students struggled, including myself. Even I was the one when I was doing SBR. Okay. Okay. So now let us go to the amortized cost. Uh, Most financial liabilities, such as borrowings, okay, are subsequently measured at amortized cost using the effective interest method. What method? Effective interest method. This is considered in more detail below. Okay, let us read this. Effective rate of interest. Okay, this is very important for you to know, because in the exam also you have to know when to measure amortized cost, and if you have to measure at amortized cost, how to measure at amortized cost. You have to know all these things. So let us go through these examples. Okay, never miss out any examples from your textbook if you are following the textbook. That is the key to pass. Assuming that a company takes out a 10 million loan for 5 years, interest of 10% is payable annually in years. So how do you calculate interest? It is simple, 10% on 10 years, 10 million. So 1 million is the interest, and the total cost of the loan will be how much? 1 million into 5 years, so 5 million, right? This is the interest. So the total cost of the loan means the interest is your cost. So you are taking 1 million for 5 years. So 1 million, 1 million, 1 million, 1 million, 1 billion into 5. That's why total 5 million is their total cost. Now assume that a company issues a bond. This has a nominal value of 10 million and interest of 10% is payable annually in arrears. However, the company issues the bond for only 9 million and has agreed to repay 12 million to the bondholders in 5 years' time. So interest will be same. Okay. Interest will be 10% on 10 million, therefore 1 million. Now the total interest payment over the life of the bond, it will be same, 5 million. Okay, but on top of this interest, the entity must pay back how much? 3 million. 12 minus 9. Okay, 3 million. So now the total cost of the loan will be 5 plus 3. Okay, 5 was the interest, now this 3 also you have to add. And in accordance with the accrual concept, this should be spread over the 5 years period. Okay, this is achieved by charging interest on the liability using the effective rate of interest. You have to charge interest on the liability using the effective rate of interest. Okay, they will give you what is the effective rate of interest, don't worry. So the effective rate is the internal rate of return on the investment. That means that is IRR of the investment. Okay, that is the effective rate. Okay, don't worry if you're not understanding the theory behind it, but definitely when we do questions you will understand this. Okay, calculating amortized cost. Now comes the calculation of amortized cost. Okay, the initial carrying amount of the financial liability measured at amortized cost is at its fair value. What is the initial carrying amount? Remember, initially we recognize at fair value, right? So if it is at fair value, what did we say? If it was at fair value, it's not far. Okay, we just finished it. We told that if it's at fair value, the first line, transaction cost should be expensed. Okay, that's why fair value minus transaction costs. Understanding? So the same thing here. Okay, initial carrying amount of financial liability will be what? If it is measured at amortized cost, okay, is fair value less any transaction cost, the net proceeds from issue. Okay, you understanding? A finance cost is charged on the so because it is fair value less any transaction cost. Okay, that will be the initial carrying amount. Finance cost is charged on the liability using the effective rate of interest. Okay, remember it's a financial liability, so interest will definitely come there. Some finance cost will come there. Logic, common sense. Okay, when you take a loan, interest will come with the loan. No, it's not just the loan, interest also comes with the loan. Same for financial liability, there will be a finance cost. Okay, it will be charged using effective rate of interest. Okay, this is the word you need to remember. This will increase the carrying amount of the liability. Definitely, right? See, when you take a 5 million loan, okay, and when you have to pay interest on it for 5 years, 1 million for the first year, just the interest. For the first 4 years is just the interest, but the final year you pay the interest plus the amount of the loan. So 1 million plus 1 million plus 1 million plus 1 million plus 5 plus 1, 6. So 6 plus 4, 10 million total you have to pay. The amount of the loan at the end will be 10 million. Interest plus the principal amount. So same way. So because of that, what happens? Because of that interest, it will be added with your principal amount. Your carrying amount of the liability, carrying amount of the loan will increase, right? Same way for financial liability also. This will increase the carrying amount of the liability. Increase the carrying amount of the liability, the interest. You understanding? So what is the journal entry for it? Where does the interest go? It is debited. It's an expense. It's in the P&L. So debit finance cost, liabilities are credit. So credit liability, because it will increase. Finance cost will increase your credit liability. So credit liability. Okay. The liability is reduced by any cash payments during the year. If you make any cash payments, remember, it will reduce the liability. Because that means you are paying in cash. So liability will reduce, no? So cash is going out, credit cash, liability is debited because liability is reduced. Okay. Now we'll go through this amortized cost table. Okay. This is how it looks like, and make sure that you memorize this pro forma, because this is the way even in your exam also you have to calculate if you want to calculate the closing liability. Okay. Because the closing liability only will appear on the statement of financial position. You need to calculate this at times if it's asked. So in the exam, assuming interest is paid in arrears, you might find the following working useful. Okay, in the exam, how do you do? You start with the opening liability. It's given to you already. Then you find the finance cost. How do you find the finance cost? It is this into this. Okay, if you see it, there is no bracket. It's an addition. Okay, operating liability is liability. Opening liability. I'm sorry. Opening liability. That means this liability, this amount, into the effective rate. Let's say the effective rate is 5%. So 5% into this X. Okay, so that will be your finance cost. That means interest. You add it. Next, we told that cash payments will reduce liability, so you deduct the cash payment. How do you get the cash payment? It is this. Okay. Nominal value. Nom means nominal value into coupon percentage. You are given coupon. Okay. Remember, your effective rate of interest and your coupon percentage are not same. They are different in interest. Okay. So that's why don't get confused with the interest rate. Sometimes people pay the coupon percentage as the interest rate, and sometimes the effective interest rate goes here. So don't interchange the two and don't get confused between the two. Okay. Effective rate of interest is used to find the interest, the cost. Coupon percentage is used for the cash payment. That in the nominal value you multiply and then you deduct it. Okay, it's a deduction, that's why it's in bracket. Then you get the closing balance. This is simple because this is only for 1 year. It's for the single year. Imagine if it was for, if this one was for 3 years or 4 years, then you have to keep on repeating this. Okay, there'll be 4 columns like this with 4 rows. Then if this was for 2 years, let's say this is 2000. When you, if you are asked to do for 2001, how do you do it? It's simple, just add another column to it, another row below. So this closing balance will become the opening liability here for 2001, and then you apply the effective interest rate, then you minus the nominal value by the coupon, and again get the closing balance. Again that closing liability will become the opening liability for the next year. You see, it keeps on repeating like that. It's nothing difficult. Okay, so we know that finance cost will be charged where? It will be charged in the statement of profit or loss. Okay, it's an expense. Cash payment, where will it go? It's an interest paid. It's in the statement of cash flow because you're paying cash. Okay, then closing liability. Closing liability will appear in the statement of financial position, right? Isn't it simple, guys? So illustration, now we'll illustrate this with a question so that you better understand this. On 1st of Jan 2001, James issued a loan note with a 500,000 nominal value. Okay. They will give you loan only because it's a financial liability. Okay. 50,000 nominal value. It was issued at a discount of 16% of nominal value. You have to see whether it's at par, whether it's at premium, whether it's at discount. The cost of the issuer. What is the cost of the issue? These are transaction cost which you have to deduct, remember. Okay, they will not give you transaction cost like that only. They might give you words like this, cost of issue, which is 2000. Interest of 5% of the nominal value is payable annually in arrears. Okay, what is it? Interest. What is this interest? Is it coupon rate or effective rate of interest? if you're confused, just see the word interest of 5% of the nominal value. So we calculate interest on the nominal value. What? Which one? Coupon interest rate. That is the coupon rate to deduct our cash payment. So this is not effective rate of interest. This is coupon rate. Okay. Sometimes they might not use the word coupon like this. If they give the coupon, then it's coupon. But if they don't give, then see the sentence. It says of the nominal value. So it is the coupon rate. Is payable annually in arrears. The bond must be redeemed on 1st of Jan 2006. Okay, so how many years? If you see, you have given it on 1st of Jan 2000 after 5 years. That means for 5 years. Definitely they will not give for the 1 year. Okay, in the exam what I've seen is 3-4 years they will give you like that. So you have to know for each year how to calculate. Okay, that means after 5 years at a premium of this one. Effective rate of interest. See, they will always give you like this. Okay, effective rate of, they will clearly say that this is the effective rate of interest, which is 12%. So don't worry about it. All the figures are given to you. It's just like put those figure in your calculation. That's it. But you should know the calculations. Okay. And definitely Excel is there now. So all these things became much easier for you. You can do Excel. Just give the formula. That's it. It will automatically calculate for all the years. How will this be reported in the financial statements of James over the period to redemption? Over the period till redemption. That means for the 5 years they are asking you. In short. Okay. Now let us see the solutions. How do you start? To start, you have to calculate the initial value of liability. Your starting point is always the initial recognition of liability. You should know how to calculate this. How do you calculate this? Fair value, okay, face value of fair value minus issue cost. We know that because transaction cost or issue cost you deduct. Okay, even the discount, if you have any discount, it's also like a cost to you, right? If you are not issuing anything at if you are issuing anything at discount, that's like a cost to you. You have to deduct that also with the issue cost. That's why 16% discount you are deducting from the face value. Okay, net process received, how much you have received. Discount you are not receiving, so you need to deduct it. Okay, so 50,000. Let's see here. Okay, we'll keep this and this together. So 50,000 is your nominal value. From 50,000 you deduct 16% discount. 16% on this 50,000. Okay, which is 8,000. Then issue cost is given to you 2,000. So you deduct, which will be 40,000. So your starting point is from 40,000. This is your opening balance of liability. Okay, see here this table. We need an opening liability, right? So that opening liability is that 40,000. That's not 50,000. That's 40,000. Okay. Now you see this. Did you see this table? This is the table which you need to know in the exam also. So liability is then measured at amortized cost. Then measured at amortized cost. Amortized cost means this only. Whenever they ask for amortized cost, you have to do this table. Okay. But first you need to calculate. See here, the opening balance is 40,000, not that 50,000 nominal value. You need to deduct the issue cost and the discount. And you have to calculate. So first column will be years, number of years, 5 year, then opening balance, then finance cost, then cash payment, then closing balance. This is the standard pro forma. You need to memorize this. So you start with 40,000. We'll go line by. How do you go? It's not like this. Opening balance, then closing. No, you go horizontally. Okay. Then you come here. Then you go here. It's horizontally like this. So we start with 40,000. Then we have effective interest rate is 12%. Remember, effective interest rate you take with the opening balance. So 12% of 40,000 is 4,800. You add it, you deduct cash payment. How much is the cash payment? 5%. Okay, on the nominal value. You don't take 5% after you add this both 40 plus 4,800. No, neither on the opening balance. Only the effective interest goes on the opening balance, but the cash payment will be on the nominal value 50,000. Okay, it's fixed. Cash payments are fixed. That's why it's 2,500, 2,500 to the each year 2,500. Okay. Then you find the closing balance 42,300. Now if you see, right? this closing balance for the first year becomes the opening balance for the next year, and this closing balance for 2000 the second year becomes the opening balance for third year. That's how you get. That means the first year you have to get correct. You have to find the closing balance for the first year, then only you will get, you can start for the second year. You understanding? So now it is repeated, same thing is repeated again. 12% on this 42,300, you get 5076, then this is fixed, then you get this, then it's repeated for all the 5 years. Then you add all these amounts are added, the finance liability, and this goes to this amount, the total of it goes to the profit and loss account. This 2500, 12,500 will go to the statement of cash flows. Okay, because it's cash payment, and the closing balance will go to the statement of financial position. You see, it goes in three places, all the three places you should know. Now, according to the above working, the total cost of the loan of the 5 year, what is the total cost of the loan? It is this only, the one which goes to the profit and loss account. That is the expense, no? 227,111. So this is made up as follows. Okay, there are another way of calculating this if you want to see. Okay, what was your capital amount? This one. What was the repayment amount? Because they told premium. Okay, let us go to that question. They told that after 5 years at a premium of 46111, it must be redeemed. So this you have to add with your nominal value. I hope I'm not going too fast. 50 with this you add. Okay, from here you add your interest, the total interest. Okay, we have already calculated it as 12,500 from above. Your cash payment. Okay, definitely your cash payment you have to add, because this also you will be paying capital plus premium and also your cash payment, not your interest. Cash payment you are adding here this time. Okay, so you take it. How much cash you have received? Only 40,000. Okay, your liability. So your opening liability is 40,000. Okay, but at the end it is this 6710. So the difference is known as total finance cost. It will be same only, this one as this one. You see, this one and this one will be same. But in the exam you have to do this, not the second method. This method only you have to do. But in order to check your answer whether it's correct or not, you can do the second method and check yourself if you have the time under the exam condition. Otherwise not needed, you can just go ahead. This table needs to be there in the exam, not this one. This one is just shown to you so that you know that there are other ways to check whether this is correct or not. Okay, now, okay, so if you see the finance charge taken to profit, the finance charge taken to profit and loss in each year is greater than the actual interest paid. Okay, this means that the value of the liability increases over the life of the instrument until it equals the redemption value at the end of its term. What is the finance charge? It is 12,000. But actual payment is how much? 12,500 only. You see? So that's what they are saying here. The finance charge is greater than the actual interest paid. Actual interest paid is only 12,500. So this means that the value of the liability increases over the life of the instrument until it equals the redemption value. That means over the life, your value of the liability will go up until it equals the redemption value at the end of its term. Okay, it should equal. Okay, it will increase, and it will reach a point at redemption. Okay, it will be equal. Okay, at the end of its term, that means the final year, it will be equal to the redemption value. That means what should be the redemption value? How much it should be equal to? Okay. So in years 1 to 4, the balance shown as a liability is less than the amount that will be payable on redemption. Okay. If you see from 1 to 4, the balance shown as a liability is less than the amount that will be payable on redemption. Therefore, the full amount payable must be disclosed in the notes to the financial statements. The full amount that will be payable must be disclosed. Okay. So all these things are not so important. Okay, what is given here and here, but at least this table you should be able to do it. Okay. Now after that we have test understanding 2. Test understanding 2 will be in the last two parts. I will be doing all your testing understanding together. Okay, I will be doing. So we can skip this. Then next method we can calculate. This all are under subsequent measurement. Remember, subsequently we can measure using 2. Amortized cost, just now we finished. Fair value through profit and loss. Now we are going through fair value through profit and loss. That's it. Then we are over with financial liability. Okay, we just need to know initial recognition and the 2 subsequent measurement. That's it. So out of the money, derivatives and liabilities held for trading are measured at fair value through profit and loss. Okay. What do you mean out of the money derivative? What was the when we started financial liability? What did we say? Not here in IS 32. That it should be non-derivative. Okay. In case you forgot, I can take you back. Okay. When we classified financial liability. Yes. Here. We told non-derivative contract. Remember? Financial liability, any non-derivative contract only. So it should not be a derivative. If it is a derivative, then it's a derivative instrument. It is not a financial liability. So that's what they have told here. Out of money derivative. Okay. And liabilities, because financial liability. Held for trading. Okay. Liability should be held for trading. Are measured at fair value through profit and loss. Normally, they will tell you that this is measured at fair value. That is the way they calculate or amortized cost. They will tell you in the exam. But remember, it is also possible to measure a liability at fair value when it would normally be measured at amortized cost. This you need to remember. Everything I'm highlighting. Because this might be asked in your exam from, okay, this part. It is possible to measure at liability at fair value when it would normally be measured at amortized cost. Okay, let's say you are normally measuring at amortized cost, but it is possible that you can later change it to fair value. Right? You can start measuring it at fair value only when these two things is there. What is it? It would eliminate. Okay, either it would eliminate or it would reduce an accounting mismatch. Okay. In this case, IFRS 9 says that any movement in fair value is split into two components. In that case, okay, fair value is split into two components. This split you should know. If normally something is measured at amortized cost, then you are saying measure it at fair value, then only this thing comes. Okay, that split. It is split into two components. What are the two components? Number one, fair value change due to the own credit risk. Okay. Number one, it is presented in other comprehensive income. Number two, it is presented in profit and loss account. But what is presented in other comprehensive income and what is presented in profit and loss account, that you should know. Okay. The fair value change due to own credit risk. That is that the entity will has issued the risk that the entity which has issued the financial liability will be unable to repay or discharge it, which is presented in other comprehensive income. The remaining fair value change, which is presented in profit and loss account. That means first you should work in OCI. If we are able to allocate to OCI, the balance, the remaining fair value is for the profit and loss account when it comes to fair value. Okay. So what goes in the OCI? The risk that they, okay, that they will be unable to repay or discharge it. It's like a credit risk. It's like you have taken a liability and now you are unable to pay it back, repay it back. It's like that. So that type of risk, credit risk. Okay. If the fair value changes due to the own credit risk, okay, if that fair value changes due to the credit risk, for example, you are unable to pay the loan, the financial liability, and then your fair value changes, then that fair value change will go to OCI, other comprehensive income. Okay. Let's say 10 million is your fair value. Out of 10 million, 5 million is you are unable to pay 5 million. So that 5 million will go to OCI. The balance 5 million will go to profit and loss account. You understand? Okay, this is explained through an illustration. We'll go through this illustration. Okay, let's see. So that's it. This is the last illustration. We are over with it. On 1st of January 2001, McGrath issued a financial liability for its nominal value of 10 million. Interest is payable at a rate of 5%. 5% is the interest. Liability is repayable on 31st December 2003. Okay, so 2001, 2002, 2003 for 3 years. They trade financial liabilities in the short term. At 31st December 2001, market rates on interest have risen to 10%. You see? Discuss the accounting treatment of liability. At 31st December 2001, that means year end. So when a fair value thing comes, remember this pro forma, which you need to do. Okay. Normally this is not asked. Normally it is the amortized cost table which you need to do, but this also you should remember, at least know it. If it comes, then you are lucky. So because the financial liability is measured in short term and so is measured at fair value through profit and loss. Okay. The liability must be remeasured to fair value at the reporting date, assuming that the fair value of the liability cannot be observed from an active market. It can be calculated by discounting feature calculate the market rate of interest. See this thing. Just read these 3 lines and tell me what can you remember. This is the same here when you're using fair value. Take a pause. You need to apply the rules of IFRS 13 fair value measurement. What did IFRS 13 say? There were 3 levels. You can go back and check my video on fair value, IFRS 13. Okay, I'm not explaining you the detail, but briefly let me tell you. There are 3 levels to measure fair value. Level 1, 2, 3. One is you observe the market. You see whether there's an active market or not. Level 2, it's like if there are similar things, if not exactly the same, similar or less active market. Level 3, there is no active market. You assume or you discount your future cash flow to to predict or to estimate a fair value. So in this case also, there is no open market to see what is the present fair value. Okay, assuming that the fair value of the liability cannot be observed from an active market. That's why they have told us. This is from IFRS 13 they are saying. Level 1 information is not there. They are going to level 3. That's why they are calculating, discounting the future cash flow at the market rate of interest. You discount the cash flow at market rate of interest always. Okay. And remember, even though they are 31st December 2001, you still need to find for this too. You need to find the present value in 2001 for the 2002 and 2003. Okay. So what is it? It is 500,000, right? Is it 500? It is 10 million 5%. Okay. So 10 million 5%. So the cash flow will be 5% on that 10,000 interest only. 0.1. Okay. They have given here. This is how you are getting the interest payment. That is 0.5. On that, you discount by using 10% because 10% is the market rate of interest. Then last year it will be the 10 million plus 0.5, so 10.5. And you discount. Okay, make sure that you know how to discount like this. Otherwise, you can use the discount factor table also. It's given there 10%. It will be given to you in your exam, the formula sheet. But if you know how to do it manually, I would say do it manually because it's much faster. Rather than going through the formula sheet and then finding out the 10%, it wastes a lot of time. Okay. round it to two decimal place, and then add it, and this is your present value 9.13. Okay, so the fair value of the liability at the year end is 9.13 million. What is the following adjustment that is required? Remember, only in the 31st December 2001, only for the current year you want how much it will go. So that's why liability, when you're taking, you have to debit liability. Liability will be reduced now. 10 minus 9.13. Out of, see, your total liability was 10 million. Out of that 9.13, you have to deduct. Because only in the current year you have to record. So in the current year, debit liability by 0.87. The difference. Okay. Credit profit and loss account. How much? The same amount, 0.87. Okay. So this is when you are doing the fair value. Okay. Take some time. Don't do this in so hurry. When you are practicing, do it slowly. Make sure you have a fresh mind. Okay. Your mind is very fresh and you are not doing anything. Okay. Then slowly, keep a time yourself that today 1 hour or at least 2 hours I'm going to spend on this. Okay. So next we have test your understanding 3. Okay, which we are going to do in the test understanding session, the last video. So next is compound instruments. With this we have finished financial liability, right? So see you in the next video on compound instruments. Till then, take care and best of luck.